Hi there, welcome to Grain TV. It's Wednesday, March 23rd. I'm Kevin McNew. We had an off day in grains. Let's take a look at the Grain Edge trading platform and see where we closed. In Chicago, corn was off 1.5 cents, wheat off 3 3/4, and beans losing 5 cents after yesterday's touch to the highest point since mid-December. Beans in particular is getting everyone's attention. We're getting a lot of calls here at Grain Hedge about the bean market. And some of the news out has been pretty light here today. There was some news about Argentina's corn crop. The Argentinian government there released their first formal forecast for their corn crop, showing it at 37 million metric tons, which includes not only field grain but also silage as well. That 37 million metric ton mark is up from last year's measure of 33.8. EIA gave us some new numbers both in ethanol and crude. In EIA's ethanol report, they showed production was off 4,000 barrels a day to 995,000 barrels, but that's still a relatively high mark. Last week we were at 999, which was the highest point since January. But the big news really came in the form of new crude oil inventories, and those inventories ballooned to 9.1 million barrels over last week. Traders had only been looking for about a 3 million barrel increase, and that sent the crude market on a tailspin lower. We had been trading about 70 to 80 cents a barrel off of yesterday's close before the announcement. By the end of today's session, we were down about $1.60, and that, in my opinion, is probably where we're going to keep going in crude, and I think that spells some problems for soybeans. If we think about what has been driving soybean prices higher over the last 3 weeks, there are several things. One has been the rally in crude. That's helped the soybean market get some strength. We've seen crude oil up $7 a barrel. But a lot of that strength was tied to expectations of a slowing production of crude and seeing those inventory numbers start to dip. And unfortunately, to date, we haven't really seen it. And today we got a big shock. So if crude starts to fall and take on steam to the downside, I think that's problematic for soybeans. Other things that have supported beans over the last 3 weeks has been the Brazilian real, which we have talked about quite extensively on Grain TV. That's been up 13% since the 1st of March, but we're starting to see it run into some resistance, and we were off 1.7% today. So if the Brazilian real starts to fall back to normal levels, that potentially is a drag on soybean prices as well, because we've been anticipating Brazilian beans becoming more expensive in the world market as their harvest starts to find its way to international channels. The other thing that has been at least supportive for soybeans has been the weakness in the US dollar. Since March, we were off 4.3%, but the last 5 days we've seen quite a bit of a turnaround, pushing back gaining back 1% of that 4.3% loss. So the reversal in the dollar is not favorable, not only for beans, but for all commodities, wheat and corn in particular. And then the last leg of this drive really has been the talk of either 2016 bringing either unchanged soybean acres by U.S. farmers, or potentially some analysts suggest it'll be even lower. And of course, a lot of this is driven by talk of huge increases in corn acres. USDA had shown an 89 million acre mark, up 1.5 million acres from last year. Some analysts are suggesting 90, 91, 92. So it's a real wild card now, but soybeans are in essence trying to buy some acres away from corn, and we're seeing that in new crop November starting to gain some strength, while D's corn really sort of drags itself on this rally, not showing much upside potential. As we look at the chart here, we talked about this yesterday being a pivotal day, that we touched up to that nearly 926.5 mark. We only got up to 924, but we've touched it twice now. Once yesterday in the middle of the session, and then overnight we touched it as well before backing off. We spent most of today's day session in a relatively flat, narrow range, somewhere between 917 for November beans on the high side, and down around 912, 913 on the low side. We closed sort of towards the upper end of that range. And so, the question is going to be, are we going to take out those highs and continue to march higher? Are we going to move lower from here. My own guesstimation is we're probably going to be moving lower. I see very little in the cards that suggest we need to keep encouraging more beans in the marketplace. The technical alert that goes out to our trading clients, we showed for May soybeans this morning, we showed a 3-day move potential to 892, and we were currently trading around 905, which is where we roughly closed the day at. So we're seeing technical indicators that suggest a move lower as well. So not only fundamentally has there been not much to hang our hat on this rally, I think technically as well we may be losing some of the steam here. If you are interested in receiving our technical alerts, go to our Grain Hedge website, sign up for a free demo of our trading platform, and learn how you can become a client of ours and get some of these valuable tools to help in your trading and marketing decisions. That's all we got on Grain TV. Join us tomorrow when we'll be talking about export sales coming out from USDA. Grain Hedge is pleased to announce a new tool called Technical Alerts. Technical Alerts is free to our trading clients and delivered by email first thing in the morning every trading day. Technical Alerts is a powerful, easy-to-use system that provides quality trading opportunities. Each trading opportunity shows a chart and analysis, providing clear price targets and risk potential to allow you to make an educated trading decision. The commodities covered include grains, livestock, crude oil, currencies, bonds, and metals. Technical Alerts look at historical chart formations and compare the current environment to the past to form concrete trading recommendations. Let's take a look at how to interpret a technical alert. At the top, you will see a red or green indicator arrow which signifies the market's likely move. Red shows when weaker prices are expected, and green for when higher prices are expected. The summary section shows the expected price target and the expected duration it should take to reach the target. Also, Technical Alerts provides both support and resistance to help you identify key levels on the price chart. Underlying support is where technicians believe there is a level of buying interest, while overhead resistance is the price level thought to trigger more active selling. The support is marked with the letter A on the corresponding price chart, and resistance is marked with the letter B. Below the chart, you will see the data interval of the bars. For example, a 1-hour data interval means the chart pattern was constructed from a 1-hour bar chart. And when you are using the Grain Hedge trading platform, you can use the pull down on your chart to change the bar interval to the appropriate time period. As always, we strive to provide you the best tools to improve your trading and hedging activity. If you have any questions on how to use technical alerts, please contact us at 877-472-4607 or by email at support@grainhedge.com.